Hong Kong down 70 points, the Taiwanese index seeing cuts of over 1%.
Rates are, in fact, going to remain higher for longer, and we're seeing that play out.
Crude prices, they've fallen overnight by around 1%. There are demand concerns globally. Of course, the rate hike phenomena that we're talking about is hurting equity. Sensex is down about 300 odd points. The Nifty is down about 70 odd points.
The price were not affected. The prices were flat compared to Q3, even before the closure and even after the closure.
We would be able to start the sinter plant very soon, in a couple of days.
Where we really focus right now is what we call our technical development capabilities.
It's a very good move and a very timely move by Government of India to invoke Section 11.
They did indicate that there would be annual savings of around $12 million, which is via restructuring of the business. The Nifty is now down, 160 odd points.
We've been achieving record levels of lending and of grants to countries, so I'm pleased with the progress.
240-point decline on the Nifty. It is below that 17,600 mark.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell. We are coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleague Surabhi here in the studios. And Nigel, as always, joins us from the newsroom floor. Guys, hi. Good afternoon. It's a deep shade of red today. And I think it's looking pretty bad. It's looking pretty poor all over, isn't it? You know, so in the last 14 minutes, before we get into the reasons, etc., and kind of try and explain what's happening, in the last 14 minutes or so, starting 2:16, there is a bit of a recovery. Let's have the intraday up, and I think it'll tell you what I'm talking about. So from the lows of the day, which is at about 17,529, we've come up about 45 points. That's a small move that is there. Let's see if we are able to build on that in any significant way, or it gets sold into. But it's been from the beginning, from the word go this morning, it's been down and down. I mean, you can look at most of Asia, markets like Korea, etc. They've also lost more than 1%. This is, of course, after the sharp cuts which we saw overnight in the US markets. Now, let me quickly revisit what the fundamentals, some of the fundamental reasons. I mean, this may be nothing new, but I think this is a large reaction and some of the biggest sort of intraday range we've seen since the day of the budget. That's the 1st of February. So it makes sense to revisit what the market is getting worried about. Factors, in a way, some are new, some are old. What is new is that there seems to be a bit of a regime change, in the sense that, after the budget, the day of the budget, 1st of February, we got a string of data out of the US, which has once again made the market believe, is making the market believe that the economy is not slowing down as the Fed wants it to. So which are these data points? You've got the jobs data first, you've got the CPI number, you've got the producer price index number, and last night we got the services PI number as well. All have beaten expectations. Actually, the services PMI is out of the contractionary zone. It's in the expansionary zone once again, which basically means that all of this data, this is good stuff, this is good data, but it's bad news because fears once again that Fed may have to do more with rate increases. The market implied terminal rate, the peak rate for the Fed funds rate, has moved up 40 basis points this month towards 5.4, and it's happened slowly. It's kind of creeped up on us, but it's a total move of 40 basis points this month in February, and I think that is quite something. We've also heard from mainstream economists, I think even people like James Bullard on the FOMC, saying that by the time we end this hiking cycle, rates in the US could get up to about 6% or so. We're not even at 5%. So I think this is what is new or incremental or different as compared to how things were being looked upon in January or December, or before that. US earnings are the other thing. Even as all of this is happening, US earnings have slowed down already. 80% of the S&P 500 companies were reported, and earnings excluding energy is down some 5% on a year-on-year basis. Here in India, just to come to factors, because this is not local in that sense, but the local factor, and I put that piece out in terms of the third quarter earnings and what it has done to full year FY24 estimates, earnings have seen sharp downgrades as well. The number of companies which have seen downgrades is far higher than those which have seen upgrades and meaningful ones at that. So no support from earnings here locally. I mean, I at least thought, Surabhi, that we kind of left the budget day levels behind, right?
Yeah.
But I think with the kind of cuts we've seen, will those come into play once again? So the budget day low is 17,353. We'll see, but that's the big sort of number on the downside to watch. And on the Bank Nifty, it's not the day of the budget, but the 30th of January low, which is 39,419, which kind of comes into play as the big support. I mean, you can talk about pivots here and there and smaller support levels, but these are the big numbers which come into sharp focus, which should not be breached. Still one full 1 hour to go for close. Maybe things do improve a little bit, but that's the state of play as things stand right now. Surabhi.
Prashant, they say markets are a great teacher in themselves, right? And I remember around the budget, a lot of us, including me, we were all thinking that the positioning is very, very lackluster before in the run-up to the budget, and then we've been underperforming. So once the event is out of the way, then the market will take off. Well, that hasn't played out for a lot of people who had that expectation, right?
But as I said, Surabhi, the last time, there's the A factor, which was completely a bolt out of the blue. I'm talking about the Adani factor.
Absolutely.
Right? That is what came in.
That makes me feel better. Thanks for reminding me, Prashant. Absolutely. But, the way look at the dollar index spiking right now, the way these moves are playing out, this is entirely global in nature. While, of course, what we saw in the first half of February was because of this A factor to an extent, as Prashant mentioned. What's happening now is entirely global in nature. The dollar index is spiking well above 104, in fact, 104.2 now. The 10-year yield, we've been talking about that. It sounds like a broken record, but it is that one factor that people are watching out for. It's pushing 3.94 last I saw it. And for the problem for the market specifically today is that there's a buyer's strike. No one wants to hold the can, including IT stocks. So pull up the contribution plate. What you'll see is that there is no counterweight in this market. Till yesterday or day before, IT was our biggest counterweight. The market has been underperforming right from the start of 2023, but IT stocks were at least finding some takers. Today, IT is out, banks are out, big boys like Reliance, because commodities are a huge drag, metals, energy, commodities, that's down, rate sensitives are down. So what are you left with? Well, the gains there. Now, look at ITC. Now, let's pull up the graphs for an ITC or a Bajaj Auto. The gain is not even, 1.5%, 2%. That's the extent of the drawdown that we are witnessing today. There you go, 0.5% on ITC, this sum on Bajaj Auto. Otherwise, it's a sea of red. The Adani Group itself, by the way, there's a huge decline on all of the group stocks today. Adani Ports, even ACC, pull up ACC. Last time I checked, it was down 4.5% to 5%. That's Adani Enterprises, Ports, Green, Transmission, you name it. There's a big rout that started again on these stocks. And finally, the mid-cap market, obviously, when you have so much of large-cap selling, can mid-caps really withstand much? Perhaps not, which is why your advanced decline screen has been looking extremely weak right from the morning. You've got less than 600 stocks advancing and over 2,300 stocks declining. So it just tells us the extent of this, the fall today. It's wide, it's deep, it's a big fall, and there's no other way of putting it. Nigel, we're not alone. That's the only saving grace. I keep looking at European markets. They're also down 1%. So at least we're not alone in this, right?
Well, that's right. Global equity actually is lowered in the last 24 hours or so, and we are participating on the downside. One would have wondered whether or not we could see a relative outperformance because we didn't really participate on the upside. But that's not to be. Today as well, we're under some pressure. And if you're looking at the options data, well, the 17,700 call, the 17,600 call, both of them are getting written very, very aggressively. The only glimmer of hope is that the 17,500 put as well, in the last 30-40 minutes or so, there's a sense that it's seeing some writing at those levels. So the hope is that 17,450, 17,500 could hold out for expiry. That's till tomorrow. Otherwise, it's still a sell on rise kind of market till we get past that 17,750, which was the earlier support. Now that becomes a bit of a resistance. So it's not looking too good, but don't rule out maybe a bit of a bounce from these lows, though it's unlikely to be very, very sustainable. We're falling under pressure. The breadth of the market as well is negative and no real place to hide. IT is under pressure. The Nifty Bank is all on the verge of breaking that 40,000 odd mark. You're hoping it takes some kind of support at around 40,100 odd. Otherwise, we could easily slide another 7 to around 800 points odd, Surabhi.
So let's watch for these levels carefully. and straight away get down to strategies. With the market behaving like this, how should you be looking at stocks or indices? What trades can you take? Well, let's take that question to Mitesh. He's joining us on this leg of the show. Mitesh, good afternoon. Thanks for joining in. Not sure, have you made money on the downside today on any of the short strategies? What's the call for the last 1 hour?
It's been a good day. Good afternoon. We were actually, penciling in a test of 17,500. We didn't actually touch that level. We got a low of around 17,529. But taking part profits, trailing the stop loss is what we have done. I think now, a couple of things have happened. One, I think today we had a gap down. So 17,758 becomes the immediate supply pivot. Also, around 17,750, we have broken some weekly averages. So now any 70, 80 point rally would further invite shorts. And I think once you break 17,500, then good chance that the 200 average of around 17,355, 360 could be visited. So I think revising the target, but would want to add on to shorts about 70, 80 points higher from current levels if we get that bounce back. Otherwise, we'll hold the balance short position which we have. On the stock side, I think I have 2 sell calls right now. JSW Steel is something which is broken down out of consolidation. So that's a sell with a stop at about 715. Look for targets of 660. And HUL is also breaking the 200 average. Is also making fresh swing lows. So that's a sell with a stop at 25.11 for targets of roughly around 24.35 on the downside.
Okay. Mitesh, we'll come back for more in a bit, but we'll see 245 lower on the Nifty, 17,000, 582 is what we have. It's a big one today. We have Prakash Diwan joining in to talk markets, to talk specific stock sectors. Sanjay Dutt of Quantum Securities is also joining us on the program to talk about the sell-off that we have on right now. Gentlemen, great to have both of you here. Sanjay, if I can come to you for a quick word on how you are seeing things and what do you make of the sort of sharp cut that we have on our hands? Would you say this is purely and in a very large way global in nature, or is this a lot to do with the earnings disappointment here as well? What's your sense?
Thank you for having me on the show, Prashant, and your friends there, colleagues there. My sense is that primarily this got to do with the way the yields are panning out. The 10-year in the US is panning out, and obviously that has implications for currency and yields across the world. This is led by that because we had some, bad data in terms of the Fed coming in the US the last few days. And we saw a good sell-off in the US equity markets also yesterday. We've seen the 10-year yield coming back to 3.95. I think that's a cause of worry. And then, of course, what we are seeing specifically today in India is got to do with a combination of that. And added to this, we have settlement pressures, obviously, unwinding wherever the overbought positions are. So combination of these have seen this aggressive, close to 300 point sell-off.
Yeah. By the way, Prashant, I was just looking at our yields while we talk about the US 10-year all the time. Yields here at home also are, you can't ignore them. 7.4% now on the benchmark, and probably explains what's going on, particularly in the rate-sensitive part of the market and even in banks. Sanjay, in fact, let me take that question to you. Now, I don't know, it's been almost 2 months since this year started. Do you still think that this is going to be a passing phase? Or could this be, building up into something a little more significant? In which case, how would you look at financials for at least the coming few months?
I think what we're seeing, Surabhi, right now, I'm glad you raised the point about domestic cost of borrowing and domestic yields, etc. We're already seeing bank fixed deposits rates of even established top PSU names going up, touching close to 8% on various tenures. So, but I sense that most of the negative and most of the, impact of the interest rates and inflation and all the data that's coming out of the US as well as coming out here, weakness in some of pockets of earnings that we saw, is more or less being reflected in the price. That's exactly the reason why we're seeing this kind of an environment for the last full month, barring aside, of course, the single corporate and Adani Group issue that we had. So combination of those has more or less adjusted stock prices. And I think there could be better times ahead for domestic equities selectively. I can't probably make a call that you'll get the 1,000 point Nifty up or not, but I think there's select pockets, banks like you asked. Some of the PSU banks are pricing in the worst. They could be good time to buy 5% here and there now. But more or less it's pricing in the negatives right now.
All right. Hi, Sanjay. Good afternoon. Sanjay, 1,000 point up, I don't think anyone's thinking about that as of now. They'll be happy with the time-wise correction. But do you think we can see a sharper correction from here? Maybe a 5-10% correction on the Nifty itself?
I don't think so. I think the risk reward for the longs are favorable at this level of 17,500 Nifty. Unless some more data comes up, which kind of compels me to take my calculations sub 17,000. But I think the 17,300, the lows that we saw on the budget day, 17,300, and this 500 odd that we saw today, I said this would be respected. So, cutting a long story short, I think risk rewards are favorable to look at some banks, look at some metal stocks, look at some intra players like L&T, etc. We probably would have better time in these select pockets than what we've seen in the last 2-3 months.
Metals, PSU banks, and which is the third area, Sanjay, you said?
A lot of the infra players like Larsen, etc. L&T,
Okay.
The bigger infra players, yeah.
Okay. Got it. Let me get Prakash Diwan into the conversation as well. Prakash, what are you making of things? In your assessment, I mean, are we starting a prolonged risk-off phase, or do you think this is just one of those days which will pass, and it's more like we're in a band, and there is perhaps some time correction which is in front of us? Your sense?
Good afternoon, Prashant. Yeah, thanks. No, I kind of concur with Sanjay's view that the market's probably responding to more of global cues and not kind of essentially reacting to anything that's overtly negative, except for some disappointment in earnings for sure. And as I said last time, a couple of times, we've been seeing this is absolutely a complete absence of positive trigger. And so the moment the market gets a sizable negative impulse from the overseas global cues, it tends to kind of give in. And remember, we were in a tighter band. We were in this band between 17,900 and 18,100, and that band there was an expectation that post the budget you would have a breakout on the upside, but you actually had a breakdown. So the same thing would reverse. Markets never oblige with what you seek or what you expect. So it's quite possible the markets could go back towards that 18,000 mark, not exactly there, but towards that. And the reason why, Prashant, we're seeing a little bit of the pressure on the market is this whole China reopening has made FIs continuously take out money from some of the more impactful sectors like banking, IT. And, not that China reopening is so convincing as yet. And that's exactly why you see this waxing and waning in terms of the flows. But that's one of the reasons why all those banks are getting into that oversold territory, because the FIs are exiting. And I don't see any reason why fundamentally you could have to start writing off PSU banks or even some of the private sector banks, which have been doing so well in these situations, to kind of load up. So, it's a good time for long-term investors to buy into value in some of the pockets. But the best strategy is to stick to the large caps, given the fact that any rebound would probably favor that rather than the small caps. And the advanced decline ratio very clearly tells you that. It's not the season for small caps, but stick to the large caps, stick to the heavyweights. And that's where your money probably is going to be made faster.
Sanjay, just want your take on one other aspect. This market anyway was very sluggish, right, from the start of this calendar year, barring one sector, and that's IT. Now, the Nifty IT is still holding a gain of about 6.5%. But if you just see the chart of the last 6 months or a year, it's beginning to trim that gain now. I think today, of course, is a pretty rough day. What's your sense? All the headlines, okay, Wipro is slashing its salaries on offer to the freshers. I mean, I don't know if that's a fresh concern brewing. We know what's happening with the NASDAQ. There's money that's starting to come off US IT. Is this going to be a pillar? What would you do with this part of the market?
Surabhi, this is not really a strength of mine in terms of gauging the technology sector or giving a call. But whatever limited 2 bits I need to add here, my sense going ahead, the IT gains, that the stock price gains would basically be absorbed and consolidated. In the sense, we may go into a sideways kind of a band. Most of the gains we've seen probably in the last few months, and we may not see too much of an upside. But at the same time, I don't see them really falling off and giving up the entire gains that we've had in the last few months. Because things are not as bad. In fact, just picking up from what we all were discussing, market never rewards consensus in the sense each one of us was so bearish on Europe and the Europe winters and the gas prices. And look where the gas prices have come, and look, Europe touching new highs in the equities out there. So, kind of bringing it back to the technology sector, I think most of us had written it off, thinking that, overseas markets are going through a rough patch, means overseas as in business, companies, so therefore IT spending cutback will happen. On the contrary, that did not happen, and we had reasonably good numbers coming from most of the IT majors, and that's why we've seen a catch-up coming in because prices got left behind. So consensus trade never proved right when we were looking at November, December last year. But to cut a long story short, I think we'll go into a consolidation phase in the technology stocks.
Okay, all right, Sanjay, final question before we let you go. Briefly mentioned that maybe some of these metal stocks are giving a good entry opportunity, and some of these special situations, well, you've done pretty well in it. I recall JSL, the Jindal Stainless Group, and they're going to merge. You had a positive call out there, and that played out quite well. We have a new steel company that's listed, that's NMDC Steel. The street seems to be building hopes that maybe there's going to be a divestment, maybe there is value in this particular entity. We had the management who spoke to us earlier today. The market capitalization is now around 11,000 crores odd. It's a 3 million ton plant. Have you played this special situation?
Nigel, I haven't really played this, but I wouldn't want to venture here because, again, what you correctly pointed out in your question that, what the government would do, divest, not divest, etc., because there's no business for government to be in steel, whether it was SAIL or NMDC. So given that uncertainty, if I have to play metal and steel, I wouldn't want to play it through an NMDC. So I really won't, and frankly, I haven't looked at it. So my, view is too limited. But broader theme, what I'm pointing out that I wouldn't want to play steel or any of the metals through a PSU. I don't think so, no.
Okay, all right. Sanjay is saying it as it is. Thanks so much for joining in. On NMDC, well, the fear is that, in fact, the plant is not yet operational. It still has a debt of close to around 5,000 crores. So all those who are bullish on it, keep in mind that you have a market capitalization, but you need to add the 5,000 crores to get your enterprise value. And then, you need to take a call post that. NMDC, the iron ore miner, will be buying 10% stake in this entity. So that's another trigger that you should be watching out for. For the time being, we'll slip into a short break. On the other side, we'll be joined by Anshul Sehgal of Kotak PMS. He'll be joining in to give us his view on markets as well as on stock-specific action.
Trying to be not all negative, and the good news is that at least the market isn't making fresh lows. In fact, that bounce that Prashant referred to, about 40-50 points off the lows of the day, that for now is sustaining. Some stocks that are managing to see buying from the lowest points include an Eicher Motors. Let's get the intraday charts. Maruti. From the lowest points, at least these stocks are finding some takers. Even NTPC for that matter. Of course, NTPC, a lot of power stocks in focus because of what's going on with the imported coal power plants. NTPC is also now still negative, but it's cutting its losses. HDFC Bank is trying to work in the bulls' favor. But again, it's still a 1.5% decline. There's no taking away from that. So these are some stocks trying to bounce from the lows. However, one group of stocks that's not showing this trend is definitely the Adani group of stocks. Most of them are under pressure, down anywhere between 3-4% to about 10%, depending on which one you're looking at. Vivek is joining in to highlight all the price moves. Vivek.
Well, absolutely right. So today what we've witnessed is that, there has been significant and renewed selling pressure across most of the Adani Group stocks. In fact, just to put it in perspective, during the peak, across most of the stocks or the peak market cap for this group was almost 24 lakh crore. And, current market cap is just around 7.6 lakh crore. And since, the release of the Hindenburg report, the erosion has been a little over 11 lakh crore as far as the Adani Group stocks are concerned. So it's a very large fall that you're seeing across the entire group. Now, in terms of stock prices, it's quite alarming the way some of the stocks have actually fallen. So Adani Total, Adani Transmission and Adani Green all three of these stocks have seen cuts of over 70% since January 24th. The other group of stocks, Adani Enterprises, Adani Power, Adani Wilmar, anywhere between 30 to 60% is where they've seen the fall. And the least impacted have been ACC, Adani Ports as well as Ambuja, again falling between 25 to 33%. NDTV too has seen a fall of over 30%. So clear sharp knock has been seen, and today there has been renewed selling pressure, especially across Adani Enterprises, that has taken it quite significantly in today's trading session.
All right, thanks a lot for that, Vivek. I like the way you put it, right? ACC has fallen the least, 25%. Oof, big fall out there. But Prakash Sivan is still with us. Prakash, what's your take? Some of these assets we have been discussing non-stop that they're quite good, but would you look to get in? Maybe in ACC, Ambuja, Adani Ports, they're top of mind.
So, Nigel, it's a little bit of a tricky situation in terms of whether this erosion in value continues and till how long, right? That's for sure a question that very few people have answers to. But interestingly, when you hear the likes of Mr. Bangur of Shree Cement, and when he talks about the kind of robustness in the business, particularly with such a large player that's happening, and the assessment is that between Ambuja and ACC, they've got a fairly decent footprint in geographies which are so promising. So if Ambuja is available at a price which I keep on saying, if it's sub 350, you're not overpaying for it, and you get an asset which is high quality. So you are buying into a stock which in the first place didn't have too much of an issue with the high P multiples or exorbitant valuations. There was never that issue because these are late entrants to the family. And that's precisely the damage also is much relatively lesser, and the recovery could probably be even better. All that, of course, depends a lot on what is the ability of the group to raise money to be able to fund expansion and enhance outlays towards working capital as well. But, at 335, 340 zones, Ambuja is definitely a very decent risk reward, provided you have a slightly longish term view and not just a tactical 2-month, 3-month play. So, yeah, I mean, there are some decent picks, but take your time. Is what my view is. Don't be in a hurry. Let the dust settle. Let the execution start taking, center stage rather than the sentiment in the market for most of these asset-rich businesses that the group has.
Okay. Thanks very much, Prakash. Appreciate you joining in, and good speaking with you on a day like today. Thanks indeed. Well, you got the market which is holding with about a 245 odd point cut, 17,580 or so is where we are at right now. Anshul Sehgal is now joining us, Head and Executive Vice President at Kotak Portfolio Management Services. Anshul, great to have you with us here. Thank you very much for your time. Good afternoon. I just want to start with, of course, the global is the global, and we are reacting to it. But what about some of the local factors like earnings, etc., Anshul? For your portfolio companies, have expectations moved down quite a bit as a whole for FY24 and beyond, or not really? Were you already conservative? Because we've heard kind of both sides. We had Sanjeev Prasad sometime back saying, well, but Sanjeev is a more conservative guy, so their expectations were trending a little lower in any case, whereas others have said that they've had to lower their estimates quite a bit. So I just want to start with that earnings question, Anshul. What's your sense?
Afternoon, Prashant. Thanks for having me. On earnings, clearly what we've seen in the broader markets is non-financial companies. They've seen a decline in earnings for this quarter. And financials have really held up on earnings quite well, which is the reason that you're not seeing significant cuts at the index level. Clearly, they've saved the day for the index in this quarter. When we speak with companies, the body language suggests that come October, November, there was a weakness in the markets. That is, I'm talking on the economy side. And December, towards the second half of December, we've seen somewhat of a stabilization on economic activity. And that sustains as we speak. January, February, that sustains. Our belief is that if you're looking at short-term perspective, there is clearly uncertainty on earnings. But, say a year, 2 years out from here, India is in an extremely sweet spot. And I have never seen in the last 10 years so much forthrightness in how companies are coming out and giving confidence on their long-term prospects. So, depends on where you stand on the fence. If you're a short-term investor, clearly there is uncertainty. But if you're a longish investor, then this is a sweet market to be investing in because small and mid caps, as also many large caps, have corrected anywhere from 15 to 40, 50%. So you will get opportunities in the markets.
All right, Anshul, and the opportunities are coming thick and fast. In the last couple of trading sessions, we've seen quite a decent correction, actually. And today, in fact, it's quite deep. But Anshul, I believe, that consumer durables is a sector that you like, on this sort of a dip. What do you like from that space? And if you could give us the rationale out there, point number one. And point number two is just on the headline index. Do you expect that we correct maybe 5-10% from here? Or that's about it? Or do we get deeper?
Nigel, if you look at on the headline index, if you look at the earnings estimates for FY25, Street is at somewhere close to 1,050 on Nifty, which means that we are trading at 17 and a half times earnings as we speak today on FY25 numbers. And those haven't in recent times been downgraded materially. Now, that while it is somewhat expensive, but it isn't really out of whack. And the second thing is that, as Seth Klarman says, that investing is the intersection of behavior and economics. Clearly, the economics suggests that we are not cheap at 17 and a half times earnings, but the behavior suggests that markets are very light. There are tremendous short positions at the end of most market participants, more than what they were, significantly more than what they were a year back. Domestic institutional investors are holding cash. FIIs have in recent times taken monies out of the markets. So markets seem light on the behavior side. The general expectation is that there is downside. If you look at both these things in conjunction, it doesn't look like there is material downside on the markets. Maybe a 5-10% volatility is a likelihood, and that remains a likelihood at any point in time. And then on your first question on consumer durables, see, if this is we are at $2,000 per capita income. China is up in the last 30 years 36 times and is at $12,500. US is at $60,000 plus dollars. We are only scraping the surface on what the opportunity on consumer durables is. The Awas Yojana and general housing going up, Ghar Se Nal Yojana, and all these things are drivers for consumer durables, and those are catching pace. The change on the ground is quite substantial. Combine that with a hot summer this year, to us, these are all makings of a very strong consumer durables season. Air conditioners, fans, washing machines, all of those, and companies that cater to these segments are likely to be beneficiaries. So we remain positive on this space.
Anshul, sorry, you've owned these for a long time? You've added them now, I mean, after the sharp corrections.
We've added many of these now.
Okay.
We have we have played this cycle post-COVID as well, the home improvement cycle in general. Those stocks had rallied quite a bit. We did book a little bit of profit, and we've started adding again now.
By the way, the bulls today would be really hoping the market closes quickly. I mean, we still have about little over 20 minutes to go, and there's no letting up of the pressure. This little bounce that we had, is it even going to hold? It's already starting to sell off. Now we're again just, 15, 20 points off the lowest levels of the day. So no real buying action, and 20 more minutes to go. That can be a long time from the bulls' perspective. Anshul, hi, good afternoon. Surabhi here. Good to talk to you after a gap. So I just want to drill on the consumer point a little more. Consumer durables we've spoken of, but you like other sections within consumer as well, right? And that's where the debate is, because after the earnings season, there's a lot of commentary around how the consumer is slowing down. It was already evident in, let's say, two-wheelers, for instance, rural demand, but maybe even the urban discretionary part could take a hit, because let's face it, prices, whether it's hotels, it's, eating out, it's flying around, buying anything, everything's more expensive now. So are you still optimistic on the consumer sector?
Surabhi, good to see you back on TV and good to be speaking with you after long. Pleasure. Yeah, so on these segments, clearly there has been in the last year commodity price pressures, as also general demand-based pressures, and which is why some of these segments, because they are long gestation, say hotels. If you conceive a hotel today, it's going to take you 3 years to 4 years, as that is considering you get land to set up a hotel. And so these are long gestation projects, and supply comes in over a period of time. But demand is as we speak, and which is why the cycle has legs. And our belief is that some of these segments will have legs on earnings, which is why you won't see wherever you have earnings visibility, you won't see material price action on the adverse side. On FMCG in particular, if you look at some of these FMCG companies and the impact of commodity price inflation, as much as 5 to 10% of their gross margins have been shaved off because of commodity prices going up. Now, commodity prices have started coming down. Now, that will add to their gross margins. In the meantime, these companies have done really nothing. They have been complete laggards since COVID, and which offers an interesting opportunity in these pockets going forward. And so our belief is that there is, while there were inflationary pressures and prices have gone up, but the demand remains so strong that, of course, near term, no one can tell, but 1, 2, 3 years, India is the market to buy, and there are enough pockets to make money in India. I'm actually spoiled for choice.
That's optimistic and the way to look at things, right? Anshul, I mean, prices are off, and you look for opportunities in what is coming off. That's always the thing to do, because you can do it at your pace, right? When markets are going up, repeated 2021, you're chasing, you don't have time, right? Before you blink, stocks are up. And that's an extremely hard thing. That's not the situation we have now. 270, 280 points lower, 17,550 or so is where we're at. Anshul, it's always a good chat. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. We'll take a break here. As always, we'll get you what dealing rooms are talking about in D Street Chatter. Nimesh, of course, gets you that. And our technical calls with our experts on the other side. Stay with us.
Welcome back. Here tuned in to Closing Bell, and we are coming to you live from the Motilal Oswal CNBC-TV18 newsroom. Well, the markets are down under pressure today, but let's understand what's really going on. Where is the selling coming from? Well, Nimesh, yesterday you told us the markets may not be doing anything, but the FIs will not be big sellers, and that played out perfectly. Today, what's your sense in terms of institutional flows?
Nigel, market is days low, down 200. Nifty is down to almost 250 points, and the feedback is they are not big sellers again. So that's the overall feedback, that the FIs are not big sellers. I guess today's fall is largely on back of what's happening in the global markets. So we're following the global cues, and the fact that there is an expiry tomorrow, so a bit of unwinding as well out of the expiry. So that's a larger reason why the Indian markets are under pressure today. In fact, the overall feedback was there is some bit of buying in select large cap, Nifty names. So that's a feedback. That was a feedback yesterday as well, and even that's been the case today. Some of the large cap names like Reliance, technology names, all are seeing some bit of deliverables buying interest. So that's the feedback. The other worry is the lack of volumes in the cash market. Even today, the volumes are on the lower side. So if you look at from compare from last week or for the last 15 days, the volumes are down 20-25%. So that's the kind of interest which is there. The participation is very, very low from retail and HN investors. So that's also playing out to a larger extent in the broader markets as well. The other big worry is the financial sector. We've been talking for the last couple of days. So that's been a big point for the Indian markets, and that's been the trend today as well. Again, the Bank Nifty is the biggest loser in today's trade. And technically, both Nifty and Bank Nifty are now below the key support level. So there is no technical support, no support from the retail and HN investors as well. The only leg which is helping the market to some extent is the FI flow. But that's again, because of the weak global cues, we are under pressure in today's trade.
I think their relationship with us is complicated. Sometimes they're big sellers. When the markets are down, they seem to be chipping in a little bit. But clearly that point on the volumes drying up is a bit of a worry, because they're down 25-30%, I think, at least. But what about individual stocks? What are you picking up out there?
So in terms of individual names, the first stock on my list today is Kirloskar Brother. We normally don't talk about this stock. Down in tourist rate, down 3%. But if you look for this month, the stock is up 11%, buzzing in trade, good volumes as well. And now the street is anticipating some sort of a large order win for this company in the near future. And hence, that stock is in my radar today. So that's the first one. The second stock is Reliance. We spoke about some bit of delivery buying in some of the heavyweights. And Reliance stands out, though the stock is down 2%. But there is good amount of buying interest at a leading FI desk in today's trade. In fact, for the last many days now, there is a consistent feedback that some bit of FI buying is back, delivery-based buying is back in Reliance Industries. So that's the second one. The third stock is Glenmark Pharma. The entire pharma pack is buzzing in trade today, and Glenmark stands out largely on back of strong FI buying again in today's trade. So that's the reason why Glenmark is in focus. And the last stock is Delivery. We spoke about how Moshe's growth is going to benefit Delivery, but there is a large block. I understand in the block deal, the leading private equity investor was a seller, and a couple of domestic mutual funds and a large hedge fund was a buyer in today's blocks. The disclosures will be important in Delivery, but what I understand, the large private equity investor was a seller in today's block.
Okay, got that. Thanks, Nimesh, very much for all the updates there and all the stocks that are on your radar. Well, the market continues to be absolutely lackluster, 17,550 thereabouts. Mitesh is back. Let's ask him what to do now. Mitesh, about 18 now. So, yeah, 12 minutes to go. What's the call and what trades will you take with an eye on tomorrow?
So trading with, very clearly some kind of short bias, I would have two STVT calls. I think Granules is closing near the low of the day. So that's an STVT with the stop at 284.5 for targets of around 273, 272 for tomorrow. And the other one is IOC. That gap down, and then again the closing is very negative. So keep a stop just about 78.5 here, look for targets of around 75.5 on the downside.
Mitesh, thanks very much for that. Actually, Mitesh, stay with us. I just want to throw this to you as well. So what I'm going to do is put out a chart, right? This is something which, this is a simple Nifty daily chart. I don't know if you can see that clearly. It should be visible. What I've done is, basically, it's a trend line, rising trend line from the lows of June, absolute lows of June, right? Which was 17th of June was when the low was made. The next touch point is the low of the budget day, right? Two pivotal days. After the lows of June, the market rallied and rallied hard. And then we, of course, had this big volatile day on the day of the budget, 1st of February 2023. And then, extended all the way through now. Basically, that level which kind of needs to hold from where the market needs to bounce or where the price meets that trend line is 17,585. Is where that is supposed to is the level which is supposed to hold, which is not holding right now. We are under it by about 40-45 points. We spent a fair bit of time around those levels, but I think we are once again below it, near to the low point of the day. I don't know, Mitesh, any thoughts on this one?
Prashant, I think, see, my sense is that while you put the trend line over there and, we've in past discussed that, I think the broader, the earlier trend line, which was in force, which started from the lows of June. And if you connect that to the lows of September, I think that was broken. And then this is possibly not having a very good slope. So I think and the indicator setup is also very negative. So I think this time the trend line is likely to break. Last time it held on to this one, but broadly I think I'm penciling in that the 200 average should be tested, and once that breaks, I think a low of around 70,100, 70,050 should be tested. So if you look at while the support is there, it can give maybe a bounce back for a day or two. So tomorrow morning you might bounce back, but the indicator setup suggests that there's a stronger chance of a breakdown.
I was actually thinking of that. Prashant, if you draw that trend line to the September-October lows of 22,
oh, that was gone.
Then I think
that was gone.
I like the fact that you were trying to be a little optimistic, but I don't know. We are at that level right now.
The 200 day is at 17,355 now, so that is still some distance away. That's 200 points away from where the market is at this point in time, which Videsh is saying should come. Let's get a global view as well. Richard Harris of Port Shelter Investment Management is with us. This is sort of global headwinds more than anything else. Richard, good to have you back on the program. Thanks for joining us on short notice. Quick thoughts, Richard. Is the US 10-year going to cross 4% in this move? And are equity markets also going to reprice themselves sharply lower in response to what's happening in the bond market? Go on.
Well, in these environments, I always like to look at basically what's happened previously, because they give an indication as to what's likely to happen on a risk-off basis, as we've seen before. And in, say, the second, third quarter of last year, we did see bond markets weaken. We did see equity markets weaken. We did see people worried about increasing interest rates. We did see people worry about inflation. And I think all of those narratives are coming back in now. So it would be consistent to see U.S. interest rates rising higher still. Now, where they're going to go is difficult, but I think that we're in a situation where we can't rule out going to 4% and maybe even going to 5%, because the inflation picture does seem to be pretty stubborn.
Richard, hi, good afternoon, and thanks for taking this call. Now, if this continues, if inflation continues to be stubborn, and if central banks stay higher for longer, I guess that's the new catchphrase these days, then what does it spell for equities? I mean, would you expect largely range-bound movement for the next couple of months, or are we potentially looking at a more serious drop, a bigger decline?
Well, I think, to be realistic, markets tend to range-bound when there's no real news. And if there's bad news, they tend to go down a lot. And if there's good news, they tend to go up a lot. Markets tend to move when they move seriously in terms of these big discontinuities. They suddenly move and then they have a period of stability. That's when you tend to get the range-bound elements, is after a big move. So, yes, it is quite possible that if the market suddenly thinks, oh, holy smoke, we've got some problems here, we could see quite a big sell-off in the market. The problem that investors have is, at the moment, you can't run and you can't hide. You don't really want to get into bonds because, it's likely that interest rates are going to go up, which means bonds go down. And you don't really want to be in equities because you feel that even if you're in shares that you really like, good companies for the future with good earnings, you're still going to lose value in them. But I think investors have to be invested. You can protect yourself by having a little bit of extra cash. And in some markets, you can protect yourself with a whole bunch of derivatives. But, there's no free lunch in markets and economics. And generally, you just have to do your best. And I think your best at the moment is having a fairly defensive portfolio and just accepting that if the market's going to go down, it's going to go down.
All right, Richard, quick conversation today, but thanks you for your comments. Interesting as always, and good to get. Appreciate you joining in today. 17,548 is where the index is at. There is exactly 5 minutes to go for a close. We have to take another quick commercial break, so let's quickly do that and see you on the other side. Okay, welcome back. Just 50 seconds, 60 seconds to go for market closing, and it's going to be not exactly at the day's low, but pretty close to the day's low, which is at 17,551 is the day's low. No, 17,529 is the day's low, and we'll close at about 17,550. So 10-15 points here and there, but this is a pretty poor outcome that we have today. 1.5% is what that translates into. The bank index closes even weaker with about a 1 3/4% cut. That, of course, has looked much weaker as compared to the Nifty over the last fortnight or so. Surabhi.
Well, as we were looking at the market, it's an entire sea of red, really. So where do I even begin? Biggest Nifty losers, Adani Ports, down about 7-odd%. And then you have, quite a few of the heavyweights like Reliance, 2.5% down. HDFC Bank was down 2%. Actually, the Bank Nifty itself is down a whole 700 points. So let's pull up some of the other major losers there. Kotak Mahindra Bank on a weak footing. If you're looking at ICICI Bank, down about 2%. Banks were out. IT didn't hold up much. Wipro is going home with a cut of about 2%. Others like Infosys, TCS, all down between 1 and 2%. There's Grasim on the losing side of the screen. Bajaj Finance has sold off about 3%. Tough day for metals. So JSW Steel, Tata Steel, a lot of these names on the downside. Nifty, well, in the green, only ITC, 0.5%. Bajaj Auto is up 0.25%, so I don't even know whether to classify that as a real gainer. And then, of course, in the broader markets, there were lots of losses. Adani Group really stands out. Just want to cap off by pointing out some of the non-nifty Adani stocks as well, whether you're looking at Enterprises, Adani Green, most of these names, Adani Power, all these stocks were down and out. Tough day for the market. All the indices, pretty wide and deep sell down. Okay. With that, the bell is gone, and we're out of time on this edition of Closing Bell. Thank you very much for watching, but we have a special market show coming up next where we are decoding this market sell-off and getting down to the nitty-gritties of what really happened. Why did the market do what it did today? Lots more coming up with a special panel of experts just after a short break.
Powered by LIC.